Akamai stock just jumped about 28% in 3 trading days. That is a massive move for a company this size, and the market added roughly $4.8 billion of value almost immediately. The trigger was not just a normal earnings reaction. Akamai reported Q1 results and highlighted a $1.8 billion 7-year cloud commitment tied to AI infrastructure. So today the question is simple. Is Akamai a buy after this move, or did the stock already price in the good news? This is not financial advice. The goal is to decide whether Akamai belongs on a research watch list after the move, not to chase a headline blindly. If that is the kind of stock research you want, subscribe to FinanceToGo, because we are going to keep breaking down big movers without the hype. So, what happened? Here's what happened before the move. Akamai closed around $116.69. Then Akamai released Q1 2026 results and pointed investors to a $1.8 billion 7-year cloud infrastructure commitment from a leading US-based frontier model provider. That detail changed how the market looked at the company. Akamai has been known for content delivery and security, but this announcement made investors ask whether the cloud infrastructure segment could become a serious AI-related growth driver. The stock closed at $147.71. On the main reaction day, then held to near $149.56 after the move. So the confirmed trigger is the Q1 release plus the AI cloud commitment. The interpretation is that investors may now be giving Akamai more credit as an AI infrastructure beneficiary. So what does the company exactly do? Akamai is not just an old content delivery network story anymore. The company now has several pieces: security, delivery, cloud applications, and infrastructure. Security is the biggest quality growth area. Delivery is the legacy business most people associate with Akamai. Cloud infrastructure is the segment that mattered most for this move, because a large AI-related customer commitment makes investors think the business may have a larger runway than they assumed before. So, let's look at the headline versus the reality. The headline is simple. A $1.8 billion AI cloud commitment sent Akamai sharply higher. But the reality is more nuanced. This is a 7-year commitment, not a sudden one-quarter revenue explosion. It is still important because it supports the cloud infrastructure story, but investors have to separate a long-term catalyst from an immediate valuation reset. The numbers show why the market got excited. Cloud infrastructure services grew 40% year over year. The valuation question is whether the new price, around $150, already includes too much of the future growth. So, did the numbers justify the move? Let's check the numbers. Q1 revenue was $1.074 billion, up 6% year over year. Security revenue was $590 million, up 11%. Cloud infrastructure services revenue was $95 million, up 40%. Those are the green flags. The cloud segment is growing quickly. And free cash flow has still meaningful at about $210.8 million. But the move was not perfect. GAAP EPS was 71 cents, down 13% year over year. Non-GAAP EPS was $1.61, down 5%. Adjusted EBITDA was also down. So this was not a clean, everything improved quarter. The stock moved because the market upgraded the future cloud story more than the current earnings line. On the chart, this looks like a fast re-rating, not a slow grind higher. Akamai moved from roughly $116 to around $150 in a few sessions. That matters because a good That matters because a good catalyst and a good entry point are not the same thing. A stock can jump for a real reason and still become less attractive if the valuation moves faster than the fundamentals. So let's look at the valuations after the move. After the move, the valuation looks fair to stretched. My working fair value range is roughly $125 to $155, and the price used here is about $149.56. That means Akamai is near the upper end of the range after the jump. The setup gets more interesting below roughly $150 to $125, where the margin of safety would be better. At the current price, the market is assuming the AI cloud commitment is not just a one-off headline, but the start of a larger growth story. So, is it a buy after the move? My answer is this. Watchlist after the move. Akamai is worth researching, but not a blind chase at this price. What supports the move is that the catalyst is real, the cloud infrastructure segment is growing fast, and Akamai still produces real cash flow. What argues against chasing is that EPS was down, adjusted EBITDA was down, and the stock already moved close to the top of the fair value range. The stock gets more interesting if it pulls back toward the research zone, if cloud infrastructure keeps accelerating, or if this one large customer win turns into a broader AI cloud demand. The setup gets worse if security slows, margins stay pressured, free cash flow weakens, or the AI cloud story proves to be mostly one customer. So, what to watch next? Here's the final answer. The Akamai move was not random hype. The $1.8 billion cloud commitment is a real catalyst, and the market had a reason to reprice the stock. But after a 28% jump, the easy part of the move may already be in the stock. For me, this is worth researching, but not a clean buy after the move call. Next, watch cloud infrastructure grow, security growth margins, free cash flow, and whether management proves that the AI cloud opportunity can expand beyond one major commitment. If you watched this far, comment below, was the Akamai move justified, or did the market overreact? And subscribe to FinanceToGo if you want more big mover breakdowns. Focus on what actually changed, what the numbers say, and whether the valuation still makes sense. Again, this is educational content only and not financial advice.